Good day, fellow investors. Green Brick Partners looks like a great value investment. On my research platform, I have this thread, Your Ideas. I'm asking for P ratio of 7, 10% yearly growth ideas from the great community we have there. And Thomas here says, you said 7 PE, 10% growth. How about 7 price earnings and 30% growth? So this is David Einhorn's Green Brick Partners, very low debt for a construction company. They are growing very fast. Dallas, Atlanta, now Houston, expanding areas, very good margins, high return on equity, and there looks to be a mega crash recovery and another crash after the IPO. That is because it was a different company. The company is just from 2014, Green Brick. So this is not to be looked at. This was some biofuel company. And then they recapitalized, reverse listing. And from here, it is Green Brick. And it has already done a great return, but still very cheap for the compounding machine. And here also says no net debt, huge inventory, land is the key there, and very good housing market also in Houston. So let's analyze Green Brick Partners. We'll do a business overview, compare the price to value, the risk, and the reward. If you like this and what we do here on this value investing channel, smash that like button and consider subscribing. So I already said this is not to be taken into account if we look at the company history. So it was founded during the great financial crisis by David Einhorn and co-founder Brickman to take advantage of the opportunities in the housing market after the crisis. So reverse recapitalization, and then Green Brick became Green Brick. They have raised 174 million back then and then made some acquisitions. The stock did really well, grew equity at a staggering pace, but it's still cheap at a P ratio of 7 and a market cap of just 2.6 billion, of which is most just owning land around Dallas, Atlanta, and they also have some financial services. If we look at the numbers over the last 10 years, huge growth in revenues, even better growth in earnings per share, growth in book value, great margins for a home building company, and total lots owned and controlled booming. So they have 37,000 lots owned. I think they are also now at 40,000 and also working on a deal on a new 40 million deal. This is what they do. They build you the house of your dreams if you want. If we look deeper at the numbers, check this. Inventory 1.9 billion. And if I look at the inventory on the annual report, so mostly land and lots developed and under development. And then they have the homes completed and under constructions that will be sold, but total inventory is 1.9 billion. If we look at the total liabilities there is just this 300 million debt bond situation. Apart from that, it's pretty clean. Total equity 1.6 billion, and we can say that you have your equity in inventory. Thus, this company represents land. So if you're looking for land investments with great profitability, because if you look at the increase in equity here, it went up more than 300 million. 300 million on the current market cap is again a double-digit value creation yield per year. So they are increasing the lots. So now we are already at 40,000 lots. They are spending money on acquisition and preparation of those lots to be able to construct there. But okay, everything looks good. And if we look at their debt levels, which is where the value is, compared to all the other peers in the industry, it is crazy conservative for the sector. If we look further, they are selling about 4,000 homes per year. Maybe it will be a little bit slower this year, but still, when you look at the margins, their cancellations rates are very, very low, which means that what they are doing looks good and they are doing well. If we look at the net income, they are making good money, almost 400 million last year and around 300 million in the previous 2 years. Everything looks really, really good. They did some buybacks a few years ago, so nothing wrong there. If we look at the cash flow, so all the net income is then reinvested in the increase in inventory. They are just buying and buying new land as value creation. Keep in mind, if there is inflation, if you own land, that should also protect you from inflation. So David Einhorn is not doing anything stupid here, just compounding that value, compounding that net income, that increasing book value, increasing equity per share over time. They've done some repurchases, 40 million, a little bit more earlier, but okay. So that is also a way, but they are focusing on returning value through land. If we look at David Einhorn's portfolio, Green Brick is the largest position. Of course, he is a founder of that, so that can be like the Geico for Benjamin Graham for David Einhorn. There is then ownership, Greenlight Capital 23% and 4.3% for the co-founder Brickman. So everything looks great. Compounding value, low debt, thus low risk because no banks can call on them, and there is the value of the land, plus they are making a 15% value creation yield on the current market capitalization on top of the land ownership. Great numbers, good value, so there is a margin of safety in land value, nothing wrong there. As I said, the equity there is compounding at a rate of 15% per year. So that is the reward, but what are the catalysts? The reward is that they can just stop buying inventory. They have 40,000 lots, they sell 4,000 per year, which means that they have 10 years of available lots for building their houses. So by not spending 400 million on new inventory, new land, they could just release 15% per year of value into dividends, buybacks, whatever. And then, of course, there was this question on the conference call. What are you going to do? Are you going to keep your investment in land at that percentage growth? And if starts slow, are you going to continue to do that or not? And the question is, of course, how are you going to decide on the incremental or additional cash capital you generate from the business, where it goes and why it goes? And the answer is they have now a large deal working on, so it's complicated, but they need to have 40 million for that acquisition. So the stock repurchases with them will be more lumpier, but they might be back in the market pretty strongly in the third quarter when the land purchases are done. Buybacks coming in the third quarter, so that could also be a catalyst for the stock. There is already 15% value creation, all else equal. They have great returns on equity, great margins, and the reward is land. You own land and you can own more of it. But of course, we are value investors, risk versus reward. What is the risk? Now, if you look at this total housing inventory, it is low, so there is expectations for more building going ahead. The industry is undersupplied as household increase. I think this is from Toll Brothers. However, you must always look at this. So at some moments in time, it can get very, very ugly in the housing market. Of course, that hasn't happened in the last 15 years, but it was extremely ugly in 2008, early 90s. So a recession would, let's say, slow down things there. Then they are focused on Dallas and Atlanta, expanding to Houston. Let's start with Dallas. They traded Luka. I mean, What? And then just for the fun, I asked, is it boring in Dallas, especially now after they traded Luka? And they say, Dallas is boring AF. Okay, just joking here, but you need to know those markets and the long term development of those markets. And their focus is and has been and will always be land. So you must understand this as a land approach to things. There was also the question, are you starting to see any cracks there in Dallas, except for the Luka trade, of course? They say already here that C minus locations are blocked, stopped. So things are changing there. We are not at these levels, but this is a risk that can always happen. Plus, if I look at the last 15 years, there was the best years in history for home builders, even better than the 2000s and the subsequent bubble. Now, prices have really exploded and not reverted even a little bit, even if mortgage rates went up. We'll discuss that. However, something also key here, if Green Brick was buying land here and they are accounting at cost, then it is an additional benefit, the increase in land values there that might be hidden on the balance sheet. Also something. However, we see this jump here, but if you look as, for example, at Atlanta, jump and then a huge decline over a few years, and this is something that can happen on the ugly side of things. Now, of course, everything looks great. Green Brick Partners is cheap, but this is the best time to be in the sector, in the business that has ever been out there. And if I ask my assistant what were the issues in the great financial crisis, there was overbuilding, collapse in housing demand and prices, and I already see here cancellations, which are significant, but times are still good. So these cancellations might also go up, especially if there is more tightening of credit and mortgage standards. There are no heavy debt loads for Green Brick Partners, which is a positive, but there can always be massive write-downs and losses if this perhaps happens in Dallas. But it could happen because if we just go back to a few years ago, you are at 50% down for home values. Of course, unlikely, but every 30 years it will happen here and there, and that is why Green Brick Partners is trading at P ratio of 7. The risk, the huge risk of a housing recession is always around the corner. So I think that 15% returns ahead are likely, maybe with ups and downs. They have a margin of safety of land, they have no debt, which is where home builders get screwed when it comes to a slowdown. And it can get ugly, but it's unlikely that Green Brick Partners will go bust. Therefore, over time, it should keep on compounding. Very low debt to capital, so everything good. The only issue I have with it is that now it really was a great time with zero interest rates, home building, investing, no other opportunities. Everything is very expensive. But give me a recession, give me a slowdown in Dallas, Atlanta, and then I'll be happy to look at it. Cyclicals are not bought at P ratio of 7. Cyclicals are bought at P ratios of 50 and sold when things look good. So buy them when things don't look that great and sell them when things look great. The land will not go anywhere in a recession. The land value will stay there. And when there is a rebound in the cycle, that value can get unlocked. And this is key here. I still haven't seen the impact of higher mortgage rates now at almost 7% compared to the 3.5% for over a decade on the housing market. Because if you look at a 7% interest rate 30-year mortgage and you need to borrow $1 million, the monthly cost is $7,500. Go back to a few years ago, the interest rate 3.5%, the monthly cost is much, much lower. And this is what determines your purchase price on the house. So reality should see housing prices decline significantly, which would make it very, very hard on home builders and values there. Perhaps mortgage rates might go even higher if the Fed can't lower rates, which might then hit the market. If we go to our value investing quadrant, I have put here green brick, very good positive returns, but there is always the higher risk of these housing prices. In a diversified portfolio, I think it's already very good for a starting position. So if you have a 20-30 value investment portfolio, want some exposure to land, this is very, very interesting. If it gets uglier, then you assess and adjust. So leave one extra purchase, but know that huge land bank unlikely to go bust, good margins, so probably also flexible, but specific risks of markets. So very interesting. I'm happy that I have made the analysis and now I have it in my bag. And when it gets ugly, I'm happy to look again. If it gets ugly, of course. Thanks for watching. See you in the next video.